Hi, everyone. Welcome to the 21 Shares Analyst Call. Welcome. Make yourself comfortable. We are going to get started. Carlos, how are you doing?
I'm great, Ellie. Hi, everyone. It's so good to be here today.
Fantastic. There is a lot to unpack in the market, right? A lot has been going on right now in digital assets and blockchain technology. What are you the most excited about, Carlos, to talk about today?
I'm really excited to talk about the investment case for Bitcoin and all the developments that have gone for Bitcoin in this first half of the year. And it's just really exciting, all the ecosystem developments happening around the Bitcoin ecosystem.
Do you think it was expected or unexpected? Especially because we published our market outlook for 2023. Is there anything that you found unexpected?
Yeah, I think some parts were expected, like Bitcoin returning to its origins, regarding the reason why it was created. But it was also very unexpected and pleasantly in some other ways. For example, the rise of ordinals and BRC20 tokens. I, for one, didn't expect Bitcoin to move beyond its use case as a store of value and just drive new use cases on the blockchain. So I think that's really exciting and one of the topics we'll talk about today.
It's so interesting because at the protocol layer, I agree that Bitcoin is quite limited, but then there is over networks connected to Bitcoin, like Rootstock and Stacks and the Lightning Network. And I think that I agree with you that innovation and advancement and developments were not really expected at the base layer in a very unique and innovative way compared to essentially what we're seeing right now with the BRC20 protocol, etc., compared to the developments that we could have seen on the Lightning Network or Stacks, right?
Yeah, absolutely. It wasn't expected at all at the base layer. But one of the potential consequences of this is that it drives more adoption for layer twos that you're mentioning, like Stacks, as Bitcoin block size is limited and it's limited in its functionality.
Yeah, absolutely. That's great. We have a well-attended audience today. Thank you so much for your time. We're going to get started shortly. So my name is 𝕋𝕚𝕠𝕕𝕖. I'm the Director of Research at 21 Shares. And we have Carlos, part of our research team, with us. Today, we're going to give you a quick run through about what happened over the past week or so and what we're basically expecting. We're going to really stick with the top 3 trends that we've seen over the past week or so. I'm sure you heard about the SEC filings against Coinbase and Binance. You heard about the filing of BlackRock and other stuff like that. We're going to walk you through some of the top trends that we are monitoring more closely in the research team. And then, of course, we want to really discuss about the investment case for Bitcoin. Bitcoin has been the best performing asset class this year so far. And we really want to break down really what happened and most importantly, what are the key moving blocks that really makes a strong case for Bitcoin. And then most importantly, if you're really curious about our data, real-time data, or if you're curious about our research, you're also going to have, of course, the slide deck after this call, but most importantly, the links and the QR code to have access to anything that you need. And in the meantime, though, if you have any questions to the research team, if you have any questions to Carlos and I, there is a chat in the room here where you can basically leave your questions. All right. Without further ado, Carlos, let's get started.
Let's get started on the market update. So last week, we saw some interesting developments. First, on the DeFi side, we saw that Tether's USDT, which is the largest stablecoin by market cap, was trading 0.3% off its peg after significant pressure triggered by short sellers. This was mostly due to speculation, and Tether's CTO mentioned that they were ready to handle any amount of redemptions. And right now, I'm just going to show you our Dune Analytics dashboard with Tether's liquidity in the 3 pool. So for those of you who are not aware, the 3 pool is one of the most important pools in the whole of DeFi. It has the deepest liquidity for the 3 largest stablecoins, which are USDT, USDC, and DAI. And usually the 3 pool has to have a benchmark of each of these 3 stablecoins of 33%, so equal weights of the 3 stablecoins. And when we have an imbalance of this benchmark, it means that liquidity is potentially drying up on one stablecoin and people are flying to safety to other stablecoins. So really the 3 curve is important because it is a leading indicator of the market sentiment for the top stablecoins. And so we saw that last week, the percentage of USDT on the curve 3 pool reached almost 75%. And has this happened historically? Yes, of course it has. It happened 2 times over the past 2 years. It happened in May 2022 after the Luna's USD collapse. And it happened in November 2022 after FTX collapse. In May, it took actually USDT about a month and a half to return to the normal levels in the curve 3 pool. And then in November, you can see here, it took about 3 weeks to return to the normal levels. So you can see that the stress test of this past week was a bit less harsh because it only took about a week and it's almost back to its benchmark right now. So it's almost back to the 33%.
In other words, as Carlos mentioned, the TLDR is that essentially when you think about how can we measure market sentiment for stable coins, essentially Curve, which is essentially just a mobile application built on the Ethereum network to trade stable coins, has been the leading indicator to understand which stablecoin is having more of a bearish sentiment or more of a bullish sentiment, right? So that's very important to remember that Curve, in other words, is essentially the index for market sentiment when it comes to stablecoins. And one of the reasons why it's super important to monitor that in real time, and bear in mind that our dashboard here is available publicly for you guys and for free, of course, to ensure that you can see the impact of how much this stablecoin can break the buck based on the fact that there is, for example, less liquidity available on chain, or that there is actually more liquidity available on chain because people are trying to short sell it, right? When you're seeing an uptick in the liquidity, for example, here, Tether, the world's largest stablecoin in the world, what you're seeing today is that there was more liquidity on chain. And the reason why is because they were essentially selling their USDT, so the Tether stablecoin, for over assets that seem to be actually more attractive when it comes to the arbitrage opportunity, right? So one of the reasons why we've seen that major uptick in liquidity and short selling has been because there were some arbitrage opportunities there across over applications where stablecoins were available, centralized exchanges like Coinbase and Kraken, but also on decentralized exchanges within crypto, like, for example, Uniswap, right? So one of the things that you always have to remember is that more and more, because of the fact that FTX collapsed, we're seeing a paradigm shift in essentially where the liquidity is going to. Is moving from centralized exchanges like Binance and Coinbase to more decentralized exchanges like Curve and Uniswap. And that's why, as we're going to see more and more market depth on these new primitives and applications built on basically blockchain technology like Ethereum, you are going to really care about that data more, and they would become essentially the benchmark to basically estimate the market sentiment. So very important to remember that, especially because when we had the banking crisis early in March, we actually saw that dashboard was extremely important to understand how people perceived essentially USDC at that time that was affected by a few banks that went into receivership when essentially they were basically shut down by financial regulators, right? So that's super important to really remember that essentially having that data in mind and available to you at your fingertips would be important to understand what's going on behind the scenes, and most importantly, in real time.
Exactly. And last week, we also had one exciting development in terms of institutional adoption. So BlackRock, which is the world's largest asset manager, officially filed for a spot Bitcoin ETF structured as a grantor trust with Coinbase as the custodian. Ellie, why don't you tell us why this is very exciting?
So I think it's very interesting in two ways. Number one, it's a stamp of approval for the asset class. It also shows that crypto is here to stay, especially in such an environment like that in a bear market. It's a very intriguing development that we're always going to keep an eye on. And of course, that opened a floodgate to more and more interest into how this asset class really fits into a diversified portfolio. And then that really puts people from 0 to 1 to really understand, okay, beyond just Bitcoin, was beyond even like the use case of a store of wealth or emerging store of value for Bitcoin, to really understand the new primitives and innovation on the platform. So I think that there will be interesting, I think, a new wave of like interest and most importantly, understanding about the asset class. Tell us more about the Federal Reserve, Carlos.
So the last week was a very macro heavy week. First, the CPI numbers came from the US at 4% for May, which is the lowest figure in 2 years. So that gave a little bit of room for the Fed to skip a rate hike in June, what was finally coming after 10 consecutive hikes since March 2022. And this matters because the Fed was putting a lot of pressure on markets, especially with rate hikes. But the pause was widely expected, and many have said that Powell's press conference after the decision was announced was very hawkish. Although it's very clear that investors are very skeptical about Powell's words, and the Fed had lost a lot of credibility in the past year. And he also mentioned that it's data dependent, what the Fed does in the next couple of months. And aside from the Fed, the European Central Bank did raise interest by 25 basis points. And they said that what they do is not dependent on what the Fed does, because in Europe, we have seen more sticky inflation than in the US, essentially. Moving on, there are some important events that we're monitoring from the research side and that we think that everyone should be aware of. The first is the decentralized exchange to decentralized exchange volume. So this ratio reached an all-time high of 22% in May on the back of some 𝕃𝕚𝕚𝕚 trading. But we think that with the recent regulatory climate in the US, for instance, with the SEC suing Coinbase and Binance, and the announcement of Uniswap before, this ratio may continue to trend higher and essentially gain momentum. And it's going to be really interesting to see if more volume moves from centralized exchanges to decentralized exchanges like Uniswap, for instance. We also have some regulation around the world that we're monitoring. We saw that A16Z, which is one of the world's largest venture capital firms, expanded to the UK. We are seeing also some embracing of crypto in Hong Kong. For instance, we saw that a Financial Times article saying that Hong Kong was pressuring HSBC and Standard Chartered Bank to essentially accept crypto clients. And we also saw that Hong Kong has given the green light for retail crypto trading. And meanwhile, the US is lagging behind in regulation. So this is very important because crypto businesses based in the US need regulatory clarity to operate efficiently and stay compliant. Otherwise, we may see a flight of capital offshore to other locations that are more open to this new asset class. And then finally, we have something that a lot of people have forgotten about. But if you remember, in March, the US government sold about 9.8K Bitcoin from the seizure of James Song's holdings. James Song had pleaded guilty to stealing these funds from the Silk Road in September 2012. And the US government essentially has declared that they intend to liquidate all of this amount, this 41K remaining Bitcoin, in 4 more batches over the course of this year. So actually, we built a Dune Analytics dashboard showing the live holdings of the US government. And you can see that this dashboard tracks the US government wallets associated with the largest 3 Bitcoin seizures. So the Silk Road seizure, the James Song seizure, and the Bitfinex hack seizure. And you can see that yesterday we had basically a move from one of the wallets of the US government of about 1.5K Bitcoin, totaling about $41 million, which went to 2 unknown or newly minted wallets. And so it's really important to keep monitoring this because, as I mentioned before, the US government has stated that they intend to liquidate 41K Bitcoin over the course of this year. And the US government is essentially right now one of the largest Bitcoin whales in existence. So you can track the dashboard here essentially for free and in real time. Ellie, do you have anything to add here?
No, that's super important that a lot of investors would be asking, but where did you find the addresses? We found the addresses from public filing. So very important that we always have the confirmation from the primary sources in order to basically build this real-time dashboard. And then most importantly, we're able to fight misconceptions or fake news whenever there is, of course, news about the fact that the US government is selling their Bitcoins, right? It's very important that these are Bitcoins seized by the government from basically multiple marketplaces in the dark web and any other hacks, and that this is not something that the market bought in the open market. So very important to remember that, but absolutely, like, the dashboards are available to you and you can use it anytime to view what's going on behind the scenes. And the really cool thing is that there is a ledger where you can see the latest transactions, as Carlos showed here, for exactly just right here, where you can see essentially in ascending order the latest transactions when the basically Bitcoin moved from the 𝕰🰸 wallets.
And so moving on to our investment case for Bitcoin, do you want to get started on this, Ellie?
I think one of the most interesting things that we discussed a lot last year together, Carlos, with the rest of the research team, has been about how can Bitcoin be placed into the wider Web3 thesis. And most importantly, how can we ensure that within that new infrastructure for the internet, there is a stronger case for a non-state financial infrastructure. And I think when Bitcoin came out in 2008, first as the white paper in October 2008, and then becoming live in 2009, we've seen that actually for the first time in Bitcoin history, there is like a narrative market fit. And the narrative market fit is very important. It's actually very analogous to product market fit. You're looking at how essentially users are adopting a new technology, adopting a new service and a product. Well, narrative is very important as well, because this drives essentially more awareness and more adoption as well. And that's for the first time in Bitcoin history, actually now 14 years, that the narrative as a non-state monetary infrastructure has been more relevant than ever because of the fact that we've seen the banking crisis unfolding in March earlier this year. And what is very interesting here is that compared to the previous bear markets that we experienced, and I've been in crypto for almost 10 years now, in the last bear market in 2018 and 2019, at some point in 2019, Bitcoin basically broke the 200-day moving average. And went on to basically move from $3,000 to more than $10,000 at that time. Of course, in hindsight, people can say that it was a dead cat bounce, because then fast forward to 6 months later, we essentially had the first cases of COVID-19 in China. But what is really interesting here is that basically Bitcoin is following the same pattern here, where we're seeing that at that time compared to 2019, today we actually have finally a narrative that makes a lot of sense, and most importantly, usability that is very important for Bitcoin. And that has been one of the main and key driver for the latest best performance of Bitcoin year to date. And I think that's one of the things that we are really monitoring to really understand when we are looking at Bitcoin as a pie, there are multiple use cases within that pie. And the majority of the use case today is basically for payments, but most importantly for non-state payments. But then we're seeing that there is actually more and more to it as the technology and the platform evolves over time. So when Carlos move on to the next slide, what we're seeing today is that, yes, Bitcoin increased by more than 70% year to date. But then most importantly, onto the next slide, now you can see that there was a clear decorrelation with the banking sector. So actually, when the bank stocks were actually collapsing because of the fact that they were becoming in receivership, we're seeing that Bitcoin was having a complete decorrelation and deconnection, or disconnected to the network, and most importantly to the equity market. So I think that's one of the patterns to really keep an eye on, especially when it comes to the correlation with the equity market, whether you can use, for example, the S&P 500 as a benchmark, or if you want to use MSCI World. But here specifically for the banking sector, this is really a testament to the narrative as Bitcoin as a non-state and sovereign monetary system.
Yeah, absolutely. And I will also highlight that after the Fed stepped in to protect all depositors from Silicon Valley Bank in March, Bitcoin not only decorrelated from bank stocks, but it also showed an increased correlation to gold, showing that investors are finally getting a Bitcoin's key narrative and the reason it was created in the first place, which is, as Ellie mentioned, a non-sovereign form of money, which exhibits unique characteristics such as being trustless, censorship resistant, and decentralized. And so I think it's really key. And other factors that may really help drive this narrative is the debasement of fiat currencies in other countries, such as Turkey, like the Turkish lira, or in Latin American countries like Venezuela or Argentina. And then another key development from Bitcoin, which is really exciting, and we mentioned at the beginning, is the rise of ordinals and BRC20 tokens. So on the chart on the right, what you can see is the Bitcoin miners revenue breakdown. So essentially the miners, who are the people who maintain the Bitcoin blockchain and maintain the security of the Bitcoin network, have the revenue from two sources. The first source is newly issued Bitcoin, which every block, new Bitcoin is issued. And then every 4 years, we have a reduction of half in the amount of Bitcoin that is issued. So that's what we known as the halving. And then the other source of revenue are the transaction fees from users interacting with the network. And so what we have seen is that over the past 2 years, basically, the monthly ratio of transaction fees to total revenue was less than 2%. It was really insignificant. So most of the miners' revenue was being derived from issuance. However, in May, this ratio reached almost 14%. And this rise in transaction fees was primarily driven by ordinals and BRC20 tokens. So ordinals are a new use case for Bitcoin that was introduced in late last year, which allows users to embed image-related data into the Bitcoin blockchain to create what people have called Bitcoin native NFTs. And then the rise of BRC20 tokens are essentially analogous to ERC20 tokens or fungible tokens on Ethereum, which people can trade with each other. And this is very positive because so far, Bitcoin had only had one use case, which was basically a store of value asset. But with this new added use cases, Bitcoin can move beyond just a store of value asset and have new sources of use cases within its ecosystem. Another positive of this is for miners, the emission of new Bitcoin will end in 2140. And so it's very important that they have another source of revenue. And that's very positive for the security network as a whole. And finally, this may add a lot of congestion to the base layer of Bitcoin, which may drive more adoption to layer 2 solutions like stacks, which add smart contract functionality to the Bitcoin network. Here we can see also another very positive point for Bitcoin, which is the correlation of returns across asset classes since 2014. So you can see that Bitcoin's correlation to other asset classes is very low, same as gold, for instance. But the correlation between gold and Bitcoin, interestingly, is also very low as well. So this makes both Bitcoin and gold a vital diversification source for traditional portfolio managers, and this can improve the portfolio risk-adjusted returns. I don't know, Ellie, if you want to add anything about this interesting data.
No, absolutely. I couldn't agree more with you. And most importantly, as we're moving on to the second half of the year, the correlation metrics would be super important to keep an eye on in real time. So on doing analytics as well, we have a Bitcoin dashboard. Think about a real-time financial statement for Bitcoin, where you can see actually in real time the correlation of Bitcoin against gold and over benchmarks. And that's super important because at the end of the day, this metric is going to really be one of the leading proxies to think about how the narrative of Bitcoin is going to play around going forward and whether this is a sustained narrative as the market moves along.
Perfect. And then finally, we have blockchain technology as a platform shift from existing mobile applications. So recently we have seen a lot of hype and a lot of momentum from artificial intelligence or AI, but it's important to remember that AI lives on top of the existing applications, whereas blockchain technology is another protocol completely and another infrastructure stack. So why don't, Ellie, you tell us why this is very important for the audience to understand?
No, absolutely. And when we think about the internet infrastructure, when you move on to the next slide, essentially since the late 1960s with the ARPANET, which was basically the predecessor of the internet that we know today and the internet protocols that we know today, that we don't think about, of course, on a daily basis, because we have these applications that are powered by all of that infrastructure that has been built for academics and military first. We're seeing that Bitcoin has a similar architecture as well. For example, with the internet, we have at the protocol layer, TCP/IP, SMTP for exchanging emails, and then the applications on top that actually galvanize new economies thanks to previous innovations that you saw in the last slide, which was basically first PCs and then the internet and then smartphones and now blockchain technology. One of the key highlights, especially in the late 1980s, when we basically had the collapse of USSR and the collapse of the Berlin Wall, was basically the rise of a more connected world, especially when the internet came out in 1993. More precisely in 1992, when basically the CERN association came out with basically the World Wide Web, right? And then we saw the first browsers and the first applications over the internet that led to the dot-com bubble in the late 1990s, early 2000s. But at the end of the day, despite the fact that we saw many stocks, including Amazon, dropping by 80% within a year in the aftermath of the dot-com bubble, there were clearly some outliers and blue chips that were incoming, including Google and Amazon and more as well as we move on to the next few decades. And we're seeing the same pattern as well with crypto, where essentially first what we were seeing today when people talk about Bitcoin and Ethereum and over protocols like Solana, these are basically protocols that are very similar to basically the transfer of information over the internet back in the late 1980s. And now we're seeing these protocols actually offering more and more highlights and use cases very similar to what we saw basically 20, 30 years ago. But in that specific case, this is for the value transfer. So think about Bitcoin, Ethereum, and other protocols as basically the TCP/IP for value transfer, but most importantly for digital ownership. And the use of digital ownership could be anything beyond just value. There could be also information, there could be also data, and that's exactly what we see at the application layer. So we have basically two layers right now in crypto that is very similar to the internet architecture. And that's a very important concept because as these protocols are evolving over time, and these are not protocols that really work in silos, they're basically open source protocols. They are having a galvanized community. Ethereum, for example, has 4,000 developers working on the protocol developments and fixing the bugs on a monthly basis actively, while Bitcoin has around 900 developers as well, really working on making sure that Bitcoin remains a secure infrastructure and also evolve over time with battle-tested technologies that they could implement onto the whole stack. These are the things that we're seeing today. And that's one of the key highlights when it comes to building the investment case for Bitcoin, which is essentially we're going to see more and more success on these protocols, thanks to the applications built on top. So one of the ways to measure the success rate for these protocols would be number one, with a two-sided demand. So we have basically the developers, which are analogous to entrepreneurs working on the next generation of applications powered by blockchain technology. The same way we saw entrepreneurs working on Amazon, Google, Uber, Zoom, etc. We're going to see the next generation really working on blockchain-only infrastructure that would really enable the removal of intermediaries to transfer value, transfer data, and most importantly, to build digital ownership. And one of the exciting things as well is to ensure that these applications have product market fit and do generate, of course, tons of revenue and create really value for the investors. And one of the things that we're really bullish about is really to understand which of these protocols, if you want to have an analogy, which of these operating systems or which of these app stores like Google Play or the App Store from the iPhone is going to win on the back of this new economy built by these applications. So that's why we're seeing that Bitcoin is going beyond just a store of wealth and that we're seeing a new economy being built on top, very analogous to what we've seen today on Ethereum with financial services in DeFi, or even for social media or entertainment with NFTs. And these are the key things that investors really need to remember in order to basically form an investment case. And that's another key reasons as to why Bitcoin is having an outperformance, especially this year. And one of the other ways to measure as well how Bitcoin has performed or becoming more dominant is to look at the market cap of Bitcoin divided by the entirety of the asset class, right? So today we're seeing that the dominance of Bitcoin is representing 50% of the entirety of the market share for crypto assets. So this is a $1 trillion asset class, and Bitcoin is representing 50% of that. And that's a measure because this is the highest dominance level for Bitcoin over the past 2 years or so. And it shows again that the market is having a consolidation, but then most importantly that as we are seeing a more robust infrastructure, we're going to see more and more applications becoming dominant in the market as well. So we could be expecting, for example, more Bitcoin-powered applications, Ethereum-powered applications having a larger market share as they actually have product market fits.
Exactly. You couldn't have said it better. And then finally, we wanted to show you where you can find our research material before moving on to answer your questions. So first of all, you can find our Dune Analytics dashboards for free online. You can just scan this QR code to enter our Dune Analytics dashboards, or you can just go into this link here. And of course, you'll receive the link after this call as well, in case you need it later. And you can also dive into sign up for our research newsletter. Every week, we release a newsletter covering the most important insights of the crypto market. And you can also download our latest State of Crypto, which talks about crypto exchange traded products and dives into all of this. I don't know if you have any questions from the audience.
Yes, we do have some questions. So for the first one, Catelo, thank you so much for your question regarding the information about our Ethereum product on Bourse. So we're going to check it out internally and then revert back to you to ensure that the issue will be solved. But stay tuned and we'll make sure that this is solved shortly. Second question. So we do have an anonymous question about our vision on Ethereum and Bitcoin. Do you think it will increase in favor of Ethereum or Bitcoin in the next few years? What would be the balance of power? I think that's basically the question here. Carlos, do you want to take it away?
Sure. My personal opinion is that obviously I don't have a crystal ball and this is not financial advice of any sort, but historically we have seen that the Ethereum Bitcoin ratio has increased on a higher time frame. And I would honestly expect it to keep happening. So I do think that Ethereum will grow at a faster rate than Bitcoin in the next few years, especially because it has the most developed DeFi ecosystem. Electric Capital released a report at the beginning of this year showing that Ethereum had the most developers working on its platform, almost, I believe, 6,000 monthly active developers. And the amount of developers working on a protocol is basically a leading and early indicator of value creation. So I think most value will be created on Ethereum, and that's a personal opinion of mine, whereas Bitcoin will thrive mostly as a monetary store of value, although it also will have other use cases as we discussed here. And this is not a given, of course, it's just thinking in terms of probabilities. So probabilistically, I think that Ethereum has a good chance of growing at a faster rate in the next few years.
I couldn't agree more. And I think if you want to have one of the best illustration about Bitcoin versus Ethereum, at the core, these are operating systems. These are essentially platforms for various use cases. But they could do the same thing, even though Bitcoin is quite limited compared to Ethereum. Ethereum is Turing complex, which means that there's much more complex use cases and new primitives that could be built on top of Ethereum. But again, because of the fact that this is a platform that is maintained by a community of like-minded people and really bright developers, we could see an evolution as well. They're not going to be static type of developments. We're going to see moving blocks going forward. And it's very similar to how basically conglomerates in the tech industry are evolving as well. For example, when you take the example of Amazon, Amazon went from like mainly a bookstore online to essentially powering the internet with cloud computing infrastructure, with Amazon Web Services. So we could see that as well with blockchain technology. We could see an evolution. The same way today, we're seeing more and more blockchains specialized to scale Ethereum more broadly and compete against the Visa network. Today, Ethereum only processes 50 transactions per second, but the Visa network processes 2,000 transactions per second, right? So we're going to see more and more of that, where these Ethereum compatible solutions are potentially going to be compatible with Bitcoin or compatible with other networks. And I think this is the market that will dictate where the demand will be directing to. But at the end of the day, what is really important is to understand that despite the fact that we don't have a crystal ball, there are some leading indicators and proxies that really helps to understand whether a pattern is sustained or there is, for example, brain drains from a network to the other, as we're seeing more and more evolution and inflows and user adoption and over applications being built on different networks, right? At the end of the day, like these are the things that we're looking into from a data perspective. And then from a macro perspective, what needs to be considered as well, or some of the key risks when it comes to how these assets are going to evolve and how are they going to basically fit into an investable asset class. And then most importantly, how this investable asset class will grow over time with more and more use cases. And that's why considering the risk are super important, like regulatory risk, technological risk, financial risk, etc., so that basically you have a comprehensive and holistic view about how these networks are going to evolve. So that's why for us, Bitcoin and Ethereum are serving today different investment cases, but they could actually be serving the same as well as these networks evolve and developers decide to basically move on to the most attractive use cases with a clear and a larger total addressable market. The same way you would try to basically evaluate new business opportunities, basically developers and entrepreneurs are thinking the same way as well in crypto. So that's one of the things that you need to keep in mind. But to respond to your question, one of the best ways to measure how this is evolving over time, if you're just looking at the price, you would basically look at, for example, the pair of BTC and USD, BTC and Ethereum when it comes to their market cap, right? So you're going to basically take the ratio of their market cap and see how close it gets or how wide it becomes.
Awesome. We have another question from Oliver. What are the thoughts on Bitcoin BRC20s?
Yeah.
And what do you think about Oshi Finance? Oshi Finance is just a decentralized exchange that is built for BRC20 tokens on Bitcoin. BRC20 tokens on Bitcoin are analogous to ERC20 tokens on Ethereum. So there are just fungible tokens that you can trade peer-to-peer with other market participants. Something that I want to highlight here is that Bitcoin at the base layer does not support smart contract functionality. This means that most BRC20 tokens turned out to actually be meme tokens in reality. So they don't have a lot of utility in and out of themselves. And you can see that if you look at the list of BRC20 tokens with most market cap, they are basically just meme coins. But this is not negative per se, because speculation is always a leading indicator to also value creation in the long term. So I think that this is a very positive development in the sense that it could drive more adoption in the future to Bitcoin layer 2s as stacks, which do support smart contract functionality and can actually ignite a booming DeFi ecosystem. Because the question related to how do we think about DeFi on Bitcoin? And I think that on the base layer, it's really hard because Bitcoin optimizes for decentralization and stability as opposed to change. Whereas in layer 2 layers like stacks, you could potentially have a booming DeFi ecosystem because they do have support for smart contracts and programmatic tokens, same as in Ethereum or Solana or Polygon or other smart contract platforms.
Yep, I couldn't agree more, for sure. And I think when you think about these new use cases, these new applications, and most importantly, primitives, what is very important is that you have multiple phases in the adoption. So very similar to the S-curve, where we have basically the innovators first and the most adventurous users that try to basically poke around with new technologies. And then we are the early majority, right? And then before crossing the chasm, we essentially have this early majority that moves on to the major majority. And then we have the laggards. And in the early days of a new technology, we're always seeing more speculative and more, I would say, use cases that haven't basically scratched the surface as to what would be the full potential. And we're seeing that as well with the internet. Like in the early 1990s, we basically had just web browsers. And then we basically have indexing services like Google that really help to basically have better searches on the internet, to have access to information. And then we had more and more social media interactions over the internet, thanks to Twitter and Facebook, etc. And then, of course, the gig economy, thanks to Uber and Airbnb and all this stuff like that. So I think we're going to see as well the similar patterns where what we're seeing today with blockchain technology have barely scratched the surface, in my opinion. And that's exactly what happened with basically NFTs. In 2017, we basically had CryptoKitties that basically congested the Ethereum network because of the fact that many people wanted to collect these avatars. on the Ethereum network to basically feed them and try to poke around with basically the new collection. But at the end of the day, it was just like the tip of the iceberg as to what people can do with NFTs. And of course, like even today, we could see NFTs moving on to digital identity for people that don't have basically birth certificate or anything that needs to be proven thanks to cryptography. And we're going to see more and more of that as well going forward. And that's why understanding that this is just the beginning is super important. And one of the best ways to understand how early we are, despite the fact that crypto is more than 10 years old, is that just 300 million people basically have access to crypto, and that's less than 5% of the world's population that are connected to the internet. And that's a very similar figure that essentially we had in the late 1990s, early 2000s for the adoption of the internet, where at that time we had less than 5% of the world's population that actually had access to personal computers, and as such as via the internet. So about the Depeg of USDT, could you briefly explain what happened in terms of short selling and arbitrage? Thank you.
Sure. What happened basically is that speculators were basically doing an attack on USDT, and they were selling USDT on Curve's 3 pool, which is the pool with the most liquidity for the 3 largest stable coins in DeFi, which is USDT, Circle's USDC, and Maker's DAI. So what speculators were doing is essentially they were swapping Tether, so USDT, they were selling Tether, and they were in return getting USDC and DAI. And what that means is that it puts a lot of pressure on the peg of USDT, and it also drives up the imbalance of the pool. And that can potentially cause depegs, as we saw briefly last week. We saw that Tether depegged about 0.3%, but they were able to meet all redemptions. An important thing to remember here is that a stable coin is basically a claim to a dollar, right? So it's basically when you own USDT, you're basically owning a promise to getting paid $1 for that USDT that you hold. And that Tether actually said that they were able to manage all redemptions and that they were going to handle them. However, one important thing to remember is that redemptions for USDT start at about $100,000. So users that hold less than $100,000 essentially have to swap USDT in order to redeem basically the stable coin. And what happened here is that it's like a bank run, where if you think that a stable coin may not be backed or something like that, a lot of people can swap that stable coin for another that maybe it's more transparent and has more certainty around it. And that's exactly what happened last week, but it was all based on speculation because Tether was able to manage redemptions at all times, and the ratio of the Curve's 3 pool went down almost immediately afterwards.
And I think most importantly, the reason is because, as Carlos mentioned, there was absolutely no evidence that Tether was not fully backed in order to ensure that there is absolutely no way to redeem fully your position for US dollars on the blockchain. But what is even more fascinating is that because of the fact that there is discrepancy in crypto when it comes to how much you can get of Tether in other places, that was exactly the arbitrage that we've seen over multiple liquidity venues, centralized exchanges like Coinbase and Kraken, but also decentralized exchanges like Curve and Uniswap. And one of the things that we've seen as well is that they were clearly short sellers. And the good thing is that we can see that in real time because some of them were borrowing assets against USDT in order to ensure that they can actually sell right off the bat for another stablecoins like USDC in order to basically buy when the market basically continues to crash again. So I think these are the things that we've seen more and more. And the good thing is that we have real-time data on the blockchain. We can actually scan and analyze that for you and provide more reports. So if you're curious about what really exactly happened with USDT on our website, so 21shares.com/insights, you will be able to see our latest newsletter that we published this week in order to basically have a better walkthrough about what really happened. But after this call, you're going to receive the key links to basically get a more deeper understanding about it. But of course, if you have any questions about it, we're very happy as well to take it away in a one-on-one call, or just send us an email directly at research@21shares, and then we'll be very happy to take that offline. Thanks, Jerome. Another question that we have here from the audience: what is the lockup period for Ethereum 2.0.
Perfect. So after Ethereum transitioned to a proof of stake consensus mechanism last year after the merge, and on April 12th, the Shanghai upgrade occurred, closing the liquidity loop on Ethereum staking. So before April, basically, validators had an indefinite lockup period on their staked ETH. But after the Shanghai upgrade, people are now able to withdraw their staked ETH. So Ethereum has a very interesting bank run proof mechanism to avoid bank runs on the networks, and has very clear rules as to what is the waiting time for validators to withdraw their Ethereum. So right now, there is a limit of 9 validator exits per epoch, or every about 6 minutes, 9 validators can exit the network, which means we have about 2,000 validator exits in maximum per day. Because the withdrawal queue right now is not so high, it actually just takes a couple of days for people to withdraw their ETH entirely from the network. And then we also have on the other side partial withdrawals, which occur automatically, and they are just a balance increase in people's wallets, and that occurs 16 withdrawals every 12 seconds, I believe. And then finally, we have a question about how Bitcoin as an asset class is positioned in the economic cycle. I believe that from all the current macroeconomic uncertainty, people have returned to Bitcoin's origins and have remembered why Bitcoin was created in the first place. So one of the primary motivations for Satoshi Nakamoto to create Bitcoin in the first place was to have an alternative form of money outside central banks' control. And I think that this resonates very good with people this year, especially in light of the banking crisis in March. People remember that Bitcoin can essentially work as a hedge against banking stability, but not just against banking stability, but fiat monetary debasement as a whole. We've seen with that ceiling crisis in the US that was resolved between Biden and the House of Representatives in the US. But we also seen it outside the US in other countries like Turkey. For example, the Turkish lira has continued to make new highs against the US dollar. And this debasement of fiat currencies can have an aha moment in people that realize how Bitcoin is essentially solves for this and is a non-sovereign form of money. We have also seen that in other places like Venezuela, Argentina, Lebanon, and I think that we'll continue to see how Bitcoin is positioned as a non-sovereign form of money, and that's how it will drive in the following cycle, I believe.
Yeah, absolutely. As we mentioned previously, the fact that the narrative of a non-state monetary infrastructure and investable asset that is neutral, accessible to everybody, but not owned by anybody is a powerful statement. And in a world with heightened geopolitical conflict, as we're seeing today, where the world is becoming more and more fragmented, and there is a need for a neutral infrastructure and money in form of money, we're seeing that there is definitely a strong investment case for basically what it's like to actually use blockchain technology around the world. We've seen that as well when the war between Ukraine and Russia started and people fled the country in Ukraine for Poland. They left with basically stablecoins on their USB keys, which was basically a ledger storing their crypto assets. So we're definitely seeing that the technology is extremely powerful, especially when people are in need of that. But then most importantly as well, as a new primitive, as a new technology innovation after cloud computing, after smartphones, after the internet, and of course, in conversions with AI and over new technologies that we're going to actually see more and more in the news, like quantum computing, we're definitely seeing that there is a Cambrian explosion of new primitives thanks to basically blockchain technology. And the fact that we are seeing that narrative playing out in the midst of a banking crisis earlier this year, and that we're seeing an outperformance of this asset class against other asset classes, especially in a tough environment that we've seen last year. And most importantly, for any asset classes last year, it was a very tough environment. We're definitely seeing that there is a testament to the interest and most importantly to the investment case for Bitcoin. But of course, we have various primers and content on what it's like to learn more and understand more about this new technology in a more concise way. We have investment theses, we have primers, we have articles, and of course, our regular newsletters. Feel free to check out our website, 21shares.com/insights. You're going to have all the links and the necessary materials for you after this call by email. But we want to thank you so much for your time. We want to thank you for really your patience. And of course, we're looking forward to seeing you more in our upcoming webinars because we have exciting guests and topics to cover going forward as well. And most importantly, Carlos, thank you so much for taking the time with me. And we wish you guys a wonderful day.
No, thank you for having me and have a good day, everyone.
Have a good day, everyone. Thank you. Bye.